started. So okay. So this is the Sakatas Homma Technical Masterclass 3. This is the third masterclass, something like this, what I'm doing. And so I, first of all, welcome you. And honestly, thank you from the bottom of my heart. It, it takes a lot to trust someone with your time and money. And I'm very thankful that you have done that to me. And so I really hope that uh, it helps you and turns out to be how you think it is going to be. Okay. So a couple of small thing. If possible, take notes. I will definitely be going to give you the videos, but better to take notes. Sometimes when you write things down, it gets stuck in your brain a little bit better. Okay. So I highly encourage you to do that. First things first. Let's talk a little bit about what to expect from the course, right? Or at least what I would expect you uh, from this course at the end. So the first thing is to develop an independent process, okay? Because it's very important for us to develop an independent, because markets, no one has figured the market itself doesn't know what he does. But if you have a process of your own, then it becomes easier. Okay. And by independent process, I mean that you, at the end of the day, you will be able to generate ideas on your own, right? According to the way you think, you sort of have, without anyone's input, you can generate an idea that this stock will do great, or this sector might be the one to look for, something like that. The second thing I want you to get from this is uh, a habit of thinking in terms of bets, in terms of risk, in terms of systems and probabilities. Okay. And so today's class will be all about these small things, and the idea of why I am going to throw out a lot of things on your face is that the whole masterclass would be thinking on these lines, and many of the things might not be very evident to you in the first class itself, but but in due course of time it will be clear by what I mean by risk, what I mean by bet, what I mean by system, what I mean by probabilities, etc., etc. Okay. The third thing is, again, be systemic. See, develop your own system and setup, right? So for example, we'll be talking more about this, but what I mean by this is, like, for example, a lot the key thing in the market is there are multiple ways to make money, but only one way that will suit you the best, your personality the best. Okay. So knowing yourself and then devising a system around your personality and choosing sort of the setup which works for you, that is what, at the end of the day, I want to at least have you begin to think on the lines of this. Fourth thing is to be more data oriented and less tipsy. Less tipsy, by less tipsy you mean like going on Twitter and following your best handles who gives you 5 to 10 trades a day. No, not this. More data, like why this trade makes sense to you. Okay, price, action, volume, whatever other things you might be interested. But the thing is more data and less tips. The one of the most important things I want you to take away from the session would be to know yourself as a trader. Okay. The thing is, day traders will make money, long term traders will make money, swing traders will make money. Okay. But the thing is, you cannot make money doing all three at once, because your personality, your system will be suited to just one way, right? So for example, Virender Sehwag and Rahul Dravid might not be the same kind of traders, for sure, right? Because of the different kind of temperament they have. So know yourself is the idea which I want you to know. I want you to find the kind of a trader which you are, and we'll talk more about this in later slides. The next thing I want is to develop a unifying idea about the market and trading. So what happens generally is that you you learn two facts about markets, let's say, And what happens is those two facts are not congruent with each other. Okay, so let's say for example you learn the fact that if you are a swing trader, that after a price move there is a little bit of tightness, and tightness is a great area to take a trade, because after tightness there is a expansion in price, right? So this is one idea, but you see that, oh, even after I trade tightness, the price is not moving up but it's moving down, because tightness, where the tightness is occurring, is very important for you to trade, right? So not just looking at bits and pieces, but looking at pieces together and join it as a whole to know, okay, the big picture, right? So the big picture is very important for you to succeed in the long term. So that is one aim which I expect you to develop after this course. And the last one is obviously accelerated learning, right? Some people take 5 years, 10 years. Some people might take a little less amount of time to learn. But the thing is, I hope that the course will accelerate whatever the learning in the learning curve you are. Okay. All right. So, very quick thing. What I expect you to do is also, if there is something which is very pressing in the sense which you don't understand what I am trying to talk, you can interrupt me anywhere, and let this be like an interactive session. Okay. So feel free to ask questions anytime. All right. So the next slide is what not to expect from the course. If you are expecting instant profitability, this course might not be for you. Okay, the 10% per month. This is not that course. I will not be spoon feeding you the holy grail system, because frankly there is no holy grail system which works for everyone. And like I said, this course will not be a course where I give you, hey, look, this is the best setup, but I am definitely going to help you to find the setup which might be the best for you. Okay, that is the goal long term. Your association with me will not be just for the 2 or 3 months of the course, but my idea is to help you grow as a trader. Okay, find you as a trader. So that is what I want to do. Okay, so the next slide we have is, I want to talk about a couple of facts about trading and markets, which as a beginner, which we might not be aware of. Okay, so the first thing is that trading is a process. It's and and as process goes, it takes time. uh, it's not a switch that, okay, switch on kar lo to you are good at trading, and switch off kar lo to you don't know anything about trading. It's more like a volume knob in the radio, right? That slowly the volume increases. Similarly, slowly your trading will also increase as your process gets refined further. Okay, so think about it in terms of a volume knob and not as a switch. Okay, and do not be disheartened if you don't see results right away. The second very key fact is that trading is not about technicals. Okay, although we will be talking 90% technicals, but it's more emotional actually. It's more about how you tackle your biases, your emotional reactions to loss, to profit, to not doing well, to doing really well. It's how you react to that determines how successful you are as a trader. Trading is basically you fighting against yourself each day, every day. Okay. Third thing is, to be honest, trading is not deterministic. It's probabilistic. So, in simple language, trading is a guessing game. See, you will have to guess where the price is going to go tomorrow, and depending on that guess, you put your money. Depends how much money you put. Depends how much you are going to lose, or are ready to lose. But at the end of the day, it's a guessing game. Uh, do not be do not listen to people saying that, oh, like, it's not. It is a guessing game. Like, let me just make this very clear to you. It's a guessing game. You are guessing where the price of the stock is going to be, and you are putting your money based on that game. Now, because it's a guessing game, you may be your guess may be wrong from time to time. Okay, just be very clear about that, because as a beginner, we think that trading is deterministic. Mane, trading is like a game of chess. You know, chess. What happens is chess. In chess, you have a move which is the right move, right? In trading, it's not like that, because in trading there are multiple factors, a which you don't know, and the multiple factors itself have lot of variables, right? And depending on those variables, the outcome of the trade will come out. Suddenly there is a war, you don't know that there's going to be a war, right? Suddenly there's crop failure, you don't know there's going to be a crop failure. So it's a guessing game at the end of the day. I am reiterating the fact so that it gets in your head that you are going to be wrong from time to time, no matter how much study you do, no matter how much you know about the company. Okay, so once you accept that you are going to be wrong from time to time, no matter pakka technical analysis aa jaye, then you will be at ease of about losing, you know, then you will be at ease of the risk which are inherent to the markets. Fourth point is very similar to the second point I'd mentioned, that it's about you competing against yourself. Doesn't matter who made 50%, 10%, 5%. If you are making 0% today, if you make 1% tomorrow, you are doing better. Trading is all about progress over perfection. Okay, it's not about competing with XYZ. It's about you, yourself. How better are you today as compared to what you were tomorrow? Just ingrain that in your head and you'll be fine in the long period of time, you know, going forward. So the next point is, like, again, I have already reiterated this, that there are multiple ways to make money, but maybe only one way that suits the best for you. And that depends, because trading is very personal, trading is unique, and we all have our unique personalities, you know. All of these personalities come from the fact that how we were raised, what kind of people were around us as kids, how our parents behaved with us, how our teachers behaved with us. A lot of the environment shape us to think how we are, and because of that thinking, we make choices. And that choice is the guessing game which I have been talking to you about. Okay, but although there are multiple ways to make money, the one approach which underlies all successful approaches is that the approach of risk first. Even if you're a day trader or a swing or a positional trader, if you will have to manage risk, you'll have to think from the point of view of risk. How much am I ready to lose? Okay, so all of these successful approaches has underlining risk approach first. The next point is that markets are fractal. Uh, so fractal ka meaning, what does fractal mean? Fractal means it's a smallest pattern which which uh, which comes over and over in many other time frames. Okay, so for example, let's say a head and shoulder in a 1 minute means the same as a head and shoulder in a weekly time frame. Okay, so that's what I mean by fractals. So markets are fractals. Stage analysis, the stages of a cycle will also appear in 5 minute time frame, will also appear in monthly and any other time frame. Okay, so the second last point is everything is cyclical. So by this what I mean is, there will be a point where people will buy, there will be a point where people will sell, and this buying and selling cycles will come over and over again. There is a very very high misconception that stocks which are fundamentally good are not cyclical. It's not true. uh, the Tata Alexis of the world will also undergo distribution, will also undergo stage 4 downtrend. uh, Great company, but this we will read and we will learn more about the cyclical nature of the stocks in the coming slides, maybe tomorrow. But know that everything is cyclical. Okay, so which means that there is a fine time to buy and there is a right time to sell. Okay, the last point I want to make is liquidity moves the market. Liquidity moves the market, which means that when there is a lot of money with people to spend around, markets will go up. When there is no money for people to spend around, markets will not move. Okay, so let me talk a little more about what I mean by this. So, so the simple question I want to pose to everyone is, what moves the price? Uh, can anyone tell me what moves the price?
Supply and demand.
Right, supply and demand. Right, it's not fundamentals. It's not X Y Z. Okay, so let me discuss explain this. So let's say the fundamentals of a company is really great and it's really undervalued. Okay, do you think just by being an undervalued and great fundamental company that the price of the stock will move? No. The price of the stock will only move when people with huge amount of money buys that stock. Okay? And that is basically demand. So let me give you the example of mango. Okay, the mango season is going to come, and peak mango season is the summer, which is about June, July. Okay, so let's take an example of I stay in Karnataka, Bangalore, so I like let's say Banganpalli. So peak Banganpalli price during May June in here would be 100 rupees per kg. Okay, but and at that time Banganpalli is really sweet, really nice, one of the best time to eat that mango. But April, when the start of the mango season happens, Banganpalli prices, although the Banganpalli quality is not great, the prices will be 250, 200 rupees per kilo. Why? Because two things: the demand is higher at that time, the supply is less. There are very less amount of mangoes available in the market, and there are more people who are willing to eat the mango because I don't know, 9 months back they had eaten the last mango, right? So if demand exceeds more than supply, the price of that commodity stock will also increase. As simple as that. So now the Banganpalli, which is 250 rupees per kilo in April, what happens when we move to May, June? 250 becomes 200, 150, and in the peak mango season, it becomes below 100. Why? Is it because demand is less? No, it's because supply is more. There is so much mango around that the ratio between demand and supply is now skewed. Okay, previously supply was less, demand was more. Now the जितना demand था उतना supply आ रहा है. Now again, after we move from June to July, August, probably September, again what happens? This time the supply again decreases. Okay, so basically the point I'm trying to make is the last point here: liquidity moves the market. And the another thing which is very important is the skewed supply demand moves the market. Okay, and this holds true for stocks as well. Guys, just a minute. Some Dr. Suman is unable to join, so I will send him the link again. Okay. So I hope this point is clear. By what I mean, that demand and supply, the fine balance between demand and supply is what moves the price. Okay. So let's talk in terms of shares. So let's say there is 100 shares of a company, and 90 shares are with promoter as well as some financial and DI institute. So there is only 10 share out of 100 which is out in the market to uh, to trade. Now that means supply is low, And imagine the people who've already got the 10 shares, they are not willing to sell. What's going to happen? The price will move. Okay, for you to get the share, you will have to pay a higher price for them to give away their shares to you. So basically, once you understand that, then you will know that how price and volumes matter, because price and volume is what is also tells where demand and supply is going. Okay, so I'll repeat this again. That demand and supply moves the price, and volume and price is what tells you exactly what is happening with the demand and what's happening with the supply. Okay. All right. So that brings us to the next slide, which is basically the most important aspect is in trading, is to know yourself. So what do I mean by knowing yourself as a trader? So knowing yourself as a trader uh, has to do with four of these questions. Okay. So the first question is, what is your most comfortable time frame? So some people are not comfortable to hold anything more than a day. They are more suited to day trading. Some people can, once they buy a company, they can hold for years on end. So they are more suited to be a long term trader, right? For me, it's more 2 to 3 days to one to 3 months, right? So my system is swing positional based. That I have discovered for myself. Okay, I try to be a long term trader. eh. I try to be a day trader. So it takes time, right? It takes time to know. Like it's just like trying a lot of different clothes before when you go to a shopping mall, right? Although you see a shirt and you have an idea that okay, yes, this shirt will suit me, but only once you sort of wear that shirt, look yourself in the mirror, then you know, right? Oh yeah, maybe I'm looking good. So similarly, you will have to like go through a lot of things to sort of figure out. Similarly, you will also have to figure out your risk tolerance. So in general, because of the time frame constraint, a day trader will have a day trader will have a smaller tolerance to risk, whereas a long-term trader is fine even if his position is 30-40% down. Okay. uh, so know what's your risk tolerance. My risk tolerance personally is, uh, if I take one trade, that trade should not cost me more than 1% of my total capital. Or in other words, on that trade, about 8 to 10% I can still take. But more than that, I will cut it out and like get out of the trade. Okay, that's my risk tolerance. I know mentally I'm okay with having minus 10% in that trade. Mentally, I'm okay with losing 1% of my total portfolio on one trade. I have experienced that, and that's why I know that. Maybe you can tolerate a little more or a little less. That I will not be able to decide for you. That is for you to decide. Okay. So what's your most comfortable setup? This is another question, and I hope you will learn about your personal best setup as we go through a lot of other setups in the course. So for example, if you ask me, I am very comfortable trading the flags, the high tide flag. I'm very comfortable anticipating a move in a flag before it comes. Okay. uh, I am also comfortable trading the IPO basis, let's say, right? So, uh, although I like inverse head and shoulders, somehow I don't feel. Although I like VCPs, but like I have in my mind, I have a hierarchy now, which setup I am very like at peace with, right? So you will have to also find this for you. Okay. The fourth one is, at last, what do you want to achieve from trading? Now, this is a sort of a philosophical question, but it also comes under the bracket of knowing yourself. Okay, so for example, for some people, they are trading just to get a steady income, sort of a return. They don't beat the market; it's fine for them. It's more about preserving the capital. than making money, which is fine. For some people it's about like getting rich and getting that kind of a lifestyle which they think they deserve or they want, which is fine. uh, for me, I am into trading, I am into this business because I want to have a financially independent life in 8 to 10 years. That is my goal, and I'm because I have sort of pinpointed, I have written it down, I know what I'm working towards, right? So my point is, you can have different things you want to achieve from trading, but be honest with yourself and write that down, right? This will help you clear a lot of things. This will also depend what kind of setup you are going to choose, what's your risk tolerance, what is the time frame that is going to help you the most to achieve this, right? The most important thing about that is, now I'm going to come, it is called biases. We are all biased human beings, okay? Biasness is ingrained in our nervous system, okay? We are biased because being biased helps us in it has helped us in our journey as a human being till now. That's why we are biased. uh, we sort of try to judge something by looking at it just once. That's what biased is, and this kind of activity has helped humans to survive when they once were living in the wild. So biasness will not leave you, okay? You might be uber talented, you might be genius, but I'm telling you, you are biased, I am biased, right? We all are biased as humans. So that personal element, that emotional element of humanness is what determines a trader's uniqueness, okay? So one thing which has helped me is to write down all my biases as I sort of go on and discover more and more about myself. Listing them down, what it helps is like, that okay, मेरे साथ ऐसा हो सकता है, मैं ऐसा वाला गलती करता हूँ, without even knowing that I'm going to do this kind of mistakes. Once you know that, once you list them down, only then you will be able to not do that, okay? And that's why, if you are a beginner, so if you've noticed, all of my whatever I have been trying to tell you has been coming from a lens of talking to a beginner, okay? So some of you might not need this nitty gritty small things about trading, but I hope the half of more than 60% of you guys are beginners. So I think this is very important for me to put it out in the first class itself. So the point is, it's okay to be advantageous because you don't know your time frame, because you don't know your risk tolerance, your setup, what you want, xyz. It's okay to wander around, it's okay to be a little bit adventurous. I'm sorry, I have written advantageous, but it's it's adventurous, okay? It's okay to be adventurous, it's okay to sort of move around from setups to setups, to sort of figure out, using trial and error method, that could take you a few months, or for some people maybe a few years. So for me, it took me around 1.5 years or 2 years to figure out a lot of things, you know the most long it took me, last year, the whole last year, I traded more than 5 to 10 setups. And only now, after 2.5 years, I am trying to settle down with a couple of setups which I think is made for me. So it's okay to be adventurous, to do a lot of trial and error during the beginning of your trading, okay? Stop listening to people who think that, oh, only one setup. Ha bhai, only one setup is fine, but at first you will have to know which is that setup for you, right? So that brings, I will come back to this a little later, but that brings me to the most important aspect in trading. Okay, that brings me to the next slide, which is basically actionable tips if you are a beginner. Okay, if you want to uh, develop yourself as a trader, and that is fast, you'll have to practice more. How will you practice more? You will practice more only when you do more trades. Okay, and so since you are a beginner and more trades means more losing money as a beginner, naturally, that is, you then you don't have to, you put less size on the trades. Let's say you have a 10 lakh account, just trade 10,000 rupees per trade. Forget about looking at profits beginning couple of months at least, right? So more practice, more trades, and less size on those trades. Now, the second very important thing is have a maximum loss amount per day, per week, per month. Day trader, swing trader, I don't know, long term trader. So having a max loss amount per day or for a stipulated amount of time, what happens is it gives you some sort of discipline that okay, I have already lost 5% of my capital this month. I'm not going to lose more. I will go back, study all my setups, what I have done, and then come back next month stronger with more data about my trading, with more feedback, and then start again. So do this just because you want to save yourself from yourself. Okay. So the third one is maximize wins at first. So trading is hard. Okay, trading is hard, and how our human mind has developed is that you need some reward. So the best way to reward yourself at trading is to have more wins. So for example, uh, you can either take a trade which gives you 5%, or you can wait for that 5% to become 50. uh, Huge money is made when you wait for that 5% to become 50, but as you begin, as you are a beginner, you want to get the feeling that you are doing well. So I would suggest that take the 5%, take the 10% at the cost of more average gain. This will help you build momentum. This will help you negate the negative days. Okay. uh, Going forward, you need to have one setup. Now this will uh, see, you cannot when you practice, you cannot practice five setups at once. Okay. Give one setup or maximum two three setups. Like, now I am not here to tell you here that hey, your brain power, your capacity is not there to juggle five setups. People can. I have definitely tried to do that, but it's generally suitable that you only go for one or two setups at a time, so that the thing is you don't mix them too, right? The fourth one is, dude, use stop loss, please. As a beginner, why you should use stop loss is, as a beginner, we do not accept the risk which are inherent to trading. Okay, we think it's deterministic. We think that we have worked hard, we have studied everything. Now after that, I have chosen this trade, and this trade will not fail. This trade will work for me. And when that fails, then you are in a place of denial. Arey, how is that -5%? Pakka aayega wapas. Then suddenly it's -10. You know, and the only way for you to stop doing that is to have a stop loss, saying that okay, this is a trade, I think it is going to do a 10% for me, and if it does -5%, then I was wrong. So when it's -5%, at that point you put a stop loss. Okay, this will help you in the long run. So you will become at some point of time mentally so strong that you might not need a stop loss at some point of time. For me, I would like to believe that I don't need a stop loss now. I am ruthless. I am so non-emotional about my trading that I know if this is going to go wrong, then I can see the trade and then uh, punch the sell button. As a beginner, we are not equipped with this sort of mentality. So that is why you use stop loss. Okay. Many of these things I will be repeating myself. I'm sorry if you guys are bored with this things, but at most important, really important. And the last one is like, stop looking at profits. Stop looking at profits. Uh, just think about the process. Just think about long term. Think about getting better rather than getting profits, at least in the beginning couple of years. The greatest trader in our generation, Mark Minervini, was not profitable for the first 5 years of his life. Who are we, right? So I mean, we can be the next Minervinis. That's what I believe. But yeah, not during the first couple of months in a bear market. Okay. All right. So that was the actionable tips for beginners, and so I will quickly go, and this is one slide I would really want everyone to put some more attention towards. So the question I'm trying to throw to you is, what are we working towards? ये सब करके मतलब क्या चाहिए हमें? What? So the ideal thing we are working towards is a trading strategy. Okay. Now this strategy will have to be profitable, and the strategy we are working towards also has to be effortless, meaning that whatever other rest of the things we have in our life, it should come and balance with it effortlessly. ऐसा नहीं है कि दो बच्चे हैं ट्रेडिंग के कारण आई एम अनेबल टू गिव टाइम टू देम, आई एम अनेबल टू गिव टाइम टू my other work. If you are not a full time, I'm unable to give time to your family. It shouldn't be like that. If it is that, then you have to change that, because that's not an ideal trading strategy for you. The third one is sustainability. It has to be something which you can still be do at 50 years of age, or at 60, or at 70. uh, I back myself to to live that long, and I would really want to still be trading when I am 60, 70, right? And so my whole process is designed of or keeping in mind that kind of sustainability. I am trying to develop my trading system, and so should you. So three things: profitable, effortless, sustainable. If at least one of the things is not in your strategy, then scratch it and start again. So at the end, the result of our ideal trading strategy should be an account curve which is rising with higher highs and higher lows. Okay. So just never forget this slide. Okay. So that is pretty much half of the first day class, and now what I would like to do is talk a little bit about some of the mental models. And the mental models are not just for beginners. These mental models are models, a way of thinking which will equip you to be a better trader as you go on in your trading journey. Okay. So the first mental model is embracing the risk first approach. So like I said, uh, doesn't matter the time frame, but risk first approach should be there. So for example, what is the risk first approach, right? Risk first approach means that even before you are in the trade, you know how much money or how much capital of yours are you going to risk in the trade. One, how much of the capital are you willing to risk in the trade? Now these two are very different things. Okay. Willing, how much of the capital you are willing to risk, and how much you are going to risk, it's two different things. So let's say you've set a stop loss of 10%, which means that that is how much you can lose. But what if you are not okay with it? What if your mental health will be screwed if that stop loss will get hit? So so get that stop loss to where that that minimum amount you are okay to lose with is, right? Or or if this is not the setup which will allow you to put that small stop loss, then get a better setup, right? Or just wait for that setup to come. So these are the things. So everything you do has to come from the risk first approach. First you determine how much you can lose or willing to lose, then only the setup comes, then only the other things comes. Okay. So that is the first thing. The second most important thing is thinking in terms of bets. Now this I'm reading a book as I speak, which is called Thinking in Terms of Bets by Annie Duke, and I would really encourage everyone to read that book. Such an amazing book. So let's talk more about this, right? So what I mean by thinking in terms of bets, like I said, trading is a guessing game. Okay, so what is a bet? So people define bet as a decision you need to make whose result you are not sure about, right? And that is exactly what trading is. You are going to buy or sell something depending upon some very intelligent guesses which you think you are making, but you are not sure that the guess will be correct or wrong, and that is a bet, right? So now the bet has two components. Okay, one is the risk and one is the reward. So So the example I'm going to give you is about a coin toss. Now the coin toss is an activity which you can also see as a bet. So for example, me and my friend, we are tossing a coin, and there are two probability. One is head and one is tail. So let's say you bet on heads. So that means uh, heads you win, tails you lose. And if you associate a reward in the head, and if you associate a risk in the tails, that is basically what bets look like, right? So for example, if if head comes, I win, I get 100 rupees. If tail comes, he wins and I will give him 100 rupee. Okay, that's a fair, that's a bet. But now the in the bet, what happens is the risk to reward is 1:1. So even if you and your friend plays 1,000 or 10,000 coin toss, you both will have the equal amount of money in the long term, right? So that is different in terms of trading. In trading, what you want is you want your profits, reward to rise and risk to become less. So that is why the best trades are the ones with asymmetric risk reward ratio. So for example, if you're buying 100 rupee share, and you have calculated your risk to be 5%, but your reward may be unlimited. Unlimited to nahi hota hai, but let's say your reward is 10 rupees or 20 rupees or 100 rupees, right? So now if your risk is 5 rupees and your share price becomes 200, so the reward is 100. 100 by 5 is 20, right? So the risk reward ratio is 1:20. You are risking 5 rupees to make 100 rupees. In other words, you are risking 1 rupee to make 20 rupee, right? So all the trades we need to think in terms of bets, and what bet includes is risk reward. And with risk and reward, we need to more think about the ratio of risk and reward. Okay, so in the same breath, since trading is a bet, that your overall result of your trading will not be dependent on just one or two trades. It will be dependent on all the 100 trades you make in the long term. And that is why there is an element of probability, right? So think about probabilities, not deterministic, like win lose, right? So your account curve will be a culmination of hundreds of trades. How hundreds of trades did, out of that maybe 50 were losers and 50 was winners, and out of those 50, maybe 10 of them went on to have a 1:20 or 1:50 risk reward, and some of them were break even. So all of these things uh, will contribute to your trading, right? And that's why the other thing comes is the position size. So the thing is, let's say you have got a trade where you think is this trade has a very high possibility of win, right? And that comes from experience, that comes from data, that comes from a lot of things. And once you get that kind of a trade, then the amount you bet in that trade, rather than 100 rupees, I'll bet 500 rupees. Okay, so your trading size, your bet size should also increase or decrease according to the probability of the trade working, right? So thinking in this term will help you do well in the long term. So that was the second mental model I wanted to talk to you about. And all of this will constitute your edge. Okay, so for example, I think my edge, because I'm trying to trade flags and high tide flags, if I develop a system where I get into a trade of a flag even before the flag breakout occurs, that is something I am trying to develop. That will be my edge going forward. People, other traders will get in the trade when the flag breakout has happened, and already 4 or 5% has gone up. I will be in the trade before the 4 or 5% is going to happen, right? So that is how I am developing the edge. So everyone's edge here will be different, because everyone Each of you are unique. Each of you will have different like different system where you are better at guessing the probability of a trade working, right? Okay. Very important in terms of bet. So, right, so there are two ways of defining what a bet is. So you can define it in terms of good bet and bad bet. Good bet money, the probability of the bet turning out in your favor is high. So for example, a coin toss is not a good bet. It's a neutral bet, right? Because we know that if you toss the coin 100 times, 50 times will be heads and 50 times roughly will be tail, right? So that's not a good bet, that's a neutral bet. But for example, if you are in Assam and the bet is that during summer the temperature is going to be above 30 degree, right? So that's a very good bet. That has a chance of 99.99% of happening, because in summer in Assam there will be like the temperature will be more than 30%. So that's a good bet. What's a bad bet? Bad bet is the probability of India winning the football World Cup in the next World Cup. It's a very bad bet. मतलब chance ही नहीं है, right? But there is another way to classify bet is as winning bet or losing bet, right? So these are again two different things. Now you think that good bet and winning bet may be the same, but they are not. So although the possibility that in Assam during summer the probability of the temperature being more than 30 might be very high, there will be one such day where there is 2 days of continuous rainfall and the temperature actually slides below 30, right? So even a bad bet can win. So similarly in trading, um, generally what happens is people don't trade a downtrending stock, but sometimes even downtrending stocks will give a move which is 20% or so, which are called the counter trend moves. So so these two are very different things, okay? So just because your bad bet won doesn't mean that bad bet will win in the long run, and that's where probability and statistics comes into play. You will have to know that a bad bet can also win, and you will also have to know that a good bet can also lose, right? So at the end of the day, as a trader, what you want to do is you should do everything which will increase the odds of the bet being a good bet, right? So the odds of the probability of winning should be increased. So we will talk about how to do this. So for example, a simple concept of only trading during a market uptrend is something which increases the odds, right? So if the indices are in a downtrend, and if you buy a stock just because the market is in a downtrend, the probability of your stock increasing is low, right? So I'm just giving you an example how everything we should do, all our trading rules should designed to be such that they they increase the bets to be a good bet. Okay, so very important mental model this. The third mental model is plan the trade, trade the plan. And I don't have to explain what this is, right? So this is very simple. If you have a plan, you need to trade that. And if you don't have a plan, don't trade. And this also, the corollary to also to this is also that don't mix up different systems and plans, right? So if there are two systems, for example, one is for a long term trader and one is for a short term trader, so they will not be able to come into a middle ground, because the short term trader will be like, are 10% I will have to get out, but the long term trader will be no 100%, right? So mixing these things up will take so much space in your head, when these two systems will be fighting together. So always have a system which is unified, right? And the trade which you are going to trade should be planned according to that unified model which is in your head. Okay, so trade the plan the trade. Okay, this is one of the most important mental models and which nobody talks about. I have not seen people talking much about this. And the model is called visualize, Mafioso visualize. There's a jet over my head, so yeah. So the mental model is very simple. Visualize, right? So visualize the possibilities of a trade even before you click buy or sell of the trade, right? So there are only two possibilities. One is the upside, one is the downside. You will have to be able to visualize your trade doing both. Okay, so for example the upside, like for example, uh I'm gonna give, most of this will be very personal, right? So for example, I got in Karur Vyasya Bank at 82. When I before even I bought Karur Vyasya, I visualized in my mind that Karur Vyasya is going to do 135, like peak. I could see the, the curve, price curve going this, doing that. Like I visualized that trade. Okay, but I also visualized that when I bought it at 82, Karur Vaishya was at 82 for some time, or like that even broke down 70, 75. And I visualized that moment that okay, if Karur Vaishya becomes, when goes from 82 to 78, 79.9, I am going to go out, right? So once you visualize that, it becomes very clear. It becomes clear that you sort of accept that it can go wrong, and it also helps you to put your stop loss more. It also helps you accept the risk more, but it also does the other thing, right? Let's It also helps you to hold the stock for when there is a small term correction in the stock. So when I visualize that Karur ratio will go to 135, when it got stuck at 110 levels, for when the market bread was not great, I could hold on to that trade. So visualizing what your stock is going to do is so important, is one of the most important things, especially if you want to be a long-term trader, right? So if you want to hold something for 4 or 5 years, and if you are buying that stock at 100, you will have to visualize that 100 is going to do a 2000 in 4 years. If you are unable to even think of that possibility, you will not hold on to that stock when that stock does a minus 20, minus 30%, right? So that's one of the most important mental models which I want you guys to think about. Okay, the other one is situational awareness. Okay, so situational awareness is basically to sort of think about what setups or what kind of trading is going to have more probability of working according to the market conditions, right? So for example, breakouts will not work as good as they were working in a raging bull market, right? Shorting will only work in a raging bear market. Pullbacks, probably, if you are still going to trade, pullbacks are the one which are going to give you better results as compared to breakout trading when the markets are sideways. So these are the things which you have to develop, which is called situational awareness, right? Okay, so and many of these things are, a higher level skill, but the thing is you will have to start already thinking in these lines to actually develop it at least, right? Okay, so we are already an hour. Let me quickly check how many slides I had for today. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Ayyo. Okay, I have a lot of slides, so it will probably go 10 to 15 minutes more, but I will just finish this slide, beginners trading mistakes to avoid, and then we will call it a day. and we'll resume from tomorrow. Okay. So this brings me to my next slide, which is basically a beginner's mistake to avoid. Okay, just a minute. Okay. So, uh, so, so here's a couple of beginner trading mistake which I have done in my trading career as a beginner, and I'm pretty sure that a lot of you will also see yourself doing that. And the point is that the whole course is designed for you to avoid this. Figure out a plan how to work. Uh, how to navigate all of these mistakes. So the first mistake is that thinking that trading is deterministic, right? Uh, like we've already talked about this at length, that if we think that there's a holy grail system, and then if we work very hard we will figure out everything there is, and if we put in enough effort and enough research, there is no way my trade is going to fail, right? Because trading is deterministic. No, it's not. Trading is a game of probability. Even if there's a chance of 99% of the winning, there is still that 1% chance of losing, and that could be that could materialize with your trade, right? So the second beginner's mistake is failure to accept risk. And since we think that there is a deterministic element with trading, we fail to accept the risk of a falling trade. मतलब इतना तो I've worked so hard. How can I fail, right? How can my trade go wrong? No, it's you will have to know that the you'll have to accept that there is a risk associated with each trade you are taking, and most beginners fail to accept this risk, right? So trading without a stop loss, that's a third beginner's mistake. So since it is so difficult to accept the risk at the beginning, you need to save your account from getting destroyed because of you. And this can only be achieved by employing a stop loss order. Having a predefined exit order punched at a certain level will save you and your account, at least in the beginning. Okay. So the third or the fourth mistake is trading without a setup. So this is again very common, right? So most beginners, their training comes from social media, Twitter, from people, from accounts like mine, others from Telegram, where where people will not even tell you why this trade is great, why this setup works. At least I try uh, to explain a lot of things on my Twitter, but I know that 99% of people don't do that. So if most of your trading ideas are coming from that kind of a place, uh, you are just a headless chicken, right? Running yourself around to the ground to exhaustion. You'll be fatigued, you'll be frustrated at the end of the day. So because of this, the fifth beginner's mistake is that you act on FOMO, the fear of missing out. You see every setup and you fear that, array, this is a good setup, I'm gonna miss this. Ah, this is a good setup, I'm gonna miss this, right? So and because of this FOMO, what happens as a beginner, you develop a lot of unhealthy habits. You know, one of those unhealthy habit is basically buying overextended stocks. So so there is a breakout happening. Like for example, what I'm gonna do is just a minute. So for example, I'll quickly show what's happening right now with the uh, what is the hot shot stock Capit, right? So what's happening in Capit is undergoing a great um, cup and handle breakout. Okay, so this is an amazing cup and handle breakout. This is the cup, this is the handle sliding down, and this was the breakout point. This was the breakout point, right? So I if I'm a beginner trader, I had already when this was not even breaking out, I had put a tweet. When this was breaking out, I had put a tweet. When this eventually broke out, I put a tweet. So the best time to buy keep it was here. somewhere here, right? So 760 to 788 or something. It is extended more than 50 to 60 rupees now. It is quite extended, right? So the best time to buy would have been here, at least if you are a swing trader. If you are a very long term trader, 3 या 4 साल 5 साल वाले trader, then it doesn't matter to you. 10% will not matter to you if your eventual goal is to make 100% out of KP, right? But if your goal is to make 10 to 20%, this the buying 10% extended will make a lot. So this is an example what I'm trying to tell you when I say that beginner's mistake is buying overextended stocks. Uh, so so another example is another beginner's mistake to avoid is basically buying after 30% down from all-time high, right? So another good example of this is ELXSI, Tata LXC. So here, what happened? There was a huge hue and cry when this guy touched 1000. Matlab peak FOMO. This is peak FOMO. Like how? Because people like us who did not buy Tata Galaxy at 4000 and दिख रहा है कि 5000 से फिर ऊपर गया, then दिख रहा है 6000 से फिर ऊपर गया, and when this like 1 2 3 4 5 weeks continuously it got up, then we were like, acha, fuck it, I'm gonna buy this now. I cannot see this stock going up and up without me anymore. So what do? You buy it at the top. Okay, that is bad. Even worse is, okay, you still did not buy at 10,000, which is fine. But now what happened? See, within two weeks, what happened from 10,000 this level to it had come down to 8,600, which is 20% discount from the top. Now is my chance. Now I'm gonna buy this stock. Now I'm gonna see how this stock will go without me, right? So this is another classic beginner mistake where we buy something just because it is down 30%, 20%, 40% from the top. Because we have a discount mentality. Like uh, if I sell you something at 10,000, you will not buy. But if I say that, hey, it's cost 20,000 but I'm gonna give you at 10,000, you are going to buy it for me, right? So this discounted mentality with stocks also is not going to work, because we fail to understand that that uh, that there is a stage analysis, that stocks move in stages, right? So something which is down 30% in 2 weeks or 20% in 2 weeks is actually probably has already topped and now is in a stage 4. So this is a classical beginner's mistake. The other beginner mistake is not buying at the all-time high or 52-week high, right? So for example, uh, Tata Elxsi had been making 52-week high since this point. 1100 made 52-week high. Here it made like every week or every other week it was making 52-week high. But as a beginner, our thought process is, अरे 52-week high पे है, all time high पे है, already इतना चढ़ गया और कितना चढ़ेगा, So so that is why we fail to realize that for a stock which is making 100x or 10x or 100%, it is going to make all-time high or 52-week high every other week. So 52-week high is actually cheaper than it looks, right? But the mentality, because stocks doesn't work like that, but other things in life works like that, right? You buy something, it's at 50% discount. You buy a shirt, it's 50% discount. It is still a very good shirt, but doesn't work with stocks, right? So you need to change that mentality. You need to start buying at 52-week high. Okay. The corollary to this is buying at buying at 52-week low. But even better mistake which we do is not cutting the losers and holding to a losing trade. So since you are not buying 52-week high stocks, you are probably left with stocks which are all losers or laggards. Okay. And your portfolio contains, out of 10 stocks, 8 or 9 which are losers. right? But what you do is you still hold on to that because you think that, oh, 30% से गिरा है, at least all time high तक तो जाएगा. But after a couple of days, you see that you are already -5 or -10%. Now the hope changes to, चलो at least मेरा buy price तक आ जाएगा. At least the price will come to my buy price, and then I will square off at break even. But that day doesn't come. It never comes. Okay. And now to offset that pain, what we do is we do the 10th beginner mistake, which is called averaging down on the losers, right? So we see that, okay, Tata Alexi is now -10% on my trade. What I'll do is I'll buy the same amount right now. So what you do is you buy 10 more shares, 100 more shares of Tata Alexi, and then what you see in the account is, okay, it was -10%, now it is -5%, right? And then you feel better about your trade because acha, now for you to break even, you will only need the stock to do some 5 point some percent, and then you'll break out and then you will get out. But the amount of money you are losing in actual trade is actually the same. Or if it goes 1% less, then you will now be actually losing double than what you were before averaging down, right? So this is a classical beginner mistake, and all of this mistake we do is to emotionally satisfy our uh, emotionally get ourselves out of the pain. you know that's how our nervous system is wired, so that we don't we don't uh, experience the pain. And that's why beginners, we do all of this classical bullshit mistakes, right? So 11th mistake, yo so 11th mistake is selling your winners too early. So right now what's happening is 9 out of your 10 stocks is all full of losers and laggards. The one winner you were able to score, what's happened in this is, okay, that winner is 10% up. Now you're already so afraid of that winner turning out to be a loser like the rest 9%. You don't want to give away that 10%, or even worse, you don't want that 10% to become zero. So what you do is you say, अच्छा 10% है, इसको तो book कर लेता हूँ. And then you actually lose on the 50% 100% more of the return which that one winner was going to give you. And that's all because it's the mentality, right? That's all because uh, yeah. So selling your winners too early, it's another beginner mistake. And mind you, I'm talking to you, but this is me 1.5 2 years ago. And all of this what I'm talking to you about is from my own experience, and I can give you each example of how I did it, how really really nice mistakes which someday maybe we'll talk about and laugh together. So the 12th beginner mistake is picking too many stocks in my portfolio. So what happened was, since I did not have any setup, since I did not have any conviction on any of the setup, and since uh, my coaching or my learning was all from social media, at the peak bull market of post COVID, I had 52 stocks in my portfolio. 52, can you imagine? So what happens when you have 52 stocks in your portfolio is that even if one stock does 100%, that will only move your portfolio by 2%. 2%, that's it. समझ रहे हो? So so then everything gets diluted. Okay, so that's another classical beginner mistake. uh, Again, do not mistake me saying that having 52 a number of stocks in your portfolio is a bad idea. People have that many stocks, but then again, your size should also matter, right? You cannot have 1 or 2 lakhs total size of your portfolio and have 52 stocks for you to gain any meaningful change just by one stock, right? So that's what I'm trying to tell you. The last beginner mistake is having too many indicators. So as a beginner, you do not know or do not know how to read correctly the price action, the price volume action. And the price volume action is the one which shows you about demand supply, which by reading that correctly, you know if this is going to move this is gonna move down, go sideways, right? And once you don't have that, what happens is that you do this. So this is me. This is Mirza International. This is me 2 years ago, 1.5 years ago. You go in search of that magic indicator. Mane and social media is full of people trying to sell you magic indicators, right? I'm telling you, all of these are not magic for sure. Some of them have some use as a beginner because things like MACD, RSI, they work. But the point is they don't work all the time, right? Uh, so so although in the beginning situation you think that these things are helping you to become a better trader, in the long run these guys will be an obstacle. It's like the crutches, you can walk without crutches, but having the crutches will not allow you to run fast. Okay, so give away the crutches. Stop using any indicator on your timeline or on your charts, and trust me, within 2 3 months you will level up as a trader. This is my guarantee to you. Okay, so these were the couple of beginner mistake which I want to share with you guys. With these all the things I have made myself, so that you know what to avoid, right? So I'm already 15 minutes uh, away from my schedule. So what we'll do tomorrow is I'll discuss about some minimal essential technical analysis tools that includes moving averages, support resistance, channels, all about channels. So I love channels, and I really think this is a great tool for people to think about price action and price movement. So we'll talk about that. Some other technical analysis tools, not very useful, but I will just go through a couple of them. Type of orders in Zerodha or any other broker you use, and we'll talk about the trading journal, emotional journal, and we'll talk about how to set up the trading view, and then stage analysis and so on and so forth. We have a lot lined up. Okay, so I will stop here and take any questions from you guys. uh, okay, all right. I'll stop my presentation. Okay. uh, Great. Any questions, guys, before we leave? Okay, if people have no questions, I want to communicate a couple of things. I thought on Saturday, both Saturday and Sunday, 10 a.m. would be great. But what happened was one of my recurrent weekly meeting got shifted to 10 in Saturday. Today I did not attend that because it was very last moment for me to change this timing. But from next week, Saturdays we'll do 8:30 p.m. And Sundays we'll do 10 a.m. as usual. Uh, the second thing is VSS. I will take your question. Okay. The second thing is I will be giving out the videos after each session. Maybe today it will take a little bit time for me to give because I'll have to set up a certain things. Um so be patient. Definitely by tomorrow you'll get both the videos. And what I would like to do is uh, have a small feedback from you guys for every class, and this is for my benefit for sure, but also I want to know that whatever I'm talking to you is actually making sense. If I'm blabbering too much about something, if I am not talking or not explaining certain things which I think is very clear but need some more, so that in future whenever I do class like this, it will be benefited for those. Okay, so those are a couple of things, and I will take questions. So, VSS, you have a question?
Thanks, Prakash. Very good session today. Thanks for that. Um, my question was around the setups and the mentality beyond the setups that you were talking. And you mentioned that for everyone it could be different. So, what exactly is that setup and what's that all about?
Right. So we will have a separate discussion with setups. So by setup, I mean, like, for example, uh, just an example, right? So I'll give you an example of, let's say, um okay, I will share my screen again, uh, very quickly. So these are technical setups. Okay. So for example, um, I don't know why my so for example, Manakasya, Mankasya, I don't know how you. So this was a high tide flag setup. Okay. So for example, uh, this is the pole of a flag, and then this is the mast of a flag. Okay. And the setup entails that you buy when this downtrend line is taken on the above, right? So this is one setup. Now another setup, so this is a flag setup. This is a technical setup. Basically, a setup entails that a setup is a bunch of rules which, when met, you can click the buy, right? So for fundamental people, that setup might be, oh, the company is so and so, sales itna kar raha hai, ye itna kar raha hai, margin suddenly has increased, and that's the trigger for you to go long, because you now think that the margin increase will show up in price, right? So that could be one setup for you, which is a fundamental setup. Most of the setups I will be talking about are mostly like this, which are price volume based, and these are technical setups. Okay. So this is a flag setup. Another setup which I will show you is an inverse head and shoulder setup. So for example, an inverse head and shoulder setup, safari. So safari में क्या हुआ? You see here. So inverse head and shoulder setup is also a setup where you basically buy when the price breaks out of the neckline. So what is the neckline? Neckline is basically, this is a shoulder, this is a head, and this is a shoulder. Okay, so this is a chart pattern, technical pattern, which we know has an edge, because once the price moves up of this neckline, so neckline is the line joining the two shoulder. So this is the shoulder, or you can even draw it like this. Uh, so the high of the shoulder one and high of the shoulder two, and when the price broke out here on this day, that was the trigger to go and buy according to this setup. Okay. So so this is what I mean by when I say setup. Now the thing is, this is a setup on a daily. This is a high, this is one kind of setup. Okay. So no, so for, if you are, let's say, if you are day trader, day trader के लिए ये setup will not be useful. If you are a long term trader, this might not be useful. So for a long term trader, what might be useful probably is if you see certain things in weekly, and maybe something which you might have bought here, or maybe here, and not here, because the safari is already sort of an extended in the course of its cycle, stage analysis cycle. So uh, so that is what I meant by setups, and that setup would be different for uh, traders with different time frames, traders with different mentalities. Okay. So another one I'll quickly show you is, so there can be an anticipation setup, or there can be, okay, let me give you a classic example. Hariom pipes, HARIOM, Hariom pipes, right? So Hariom pipes has been a setup for me according to ACR. Okay, so this is a setup. So ACR setups, Sakatas ACR stands for ascending channel reversal. So the theory of the setup, or the hypothesis, is that once a stock is in a stage 2 uptrend, it moves in a well defined channel. तो similar thing has happened. So channel के bottom में आया, top bottom top bottom top bottom. So if this holds true, then a profitable strategy would be to buy when it strikes the bottom, like here or here, and sell some when it strikes the top. So sell here, sort of buy here, sell here, buy here, sell here, buy here. And yesterday or day before yesterday, I put out a tweet saying that it might be in a zone where you can sell some. So this is a setup. Now this setup is very good because it gives you a very low risk. So for example, if you had bought on this day, then your risk was pretty much non-existent, right? 3 or 4%, मतलब 3 or 4% के नीचे if this comes, which means that now the stock no longer is in a channel. Like for example, what happened in M&M, like, so M&M was in this setup for a long time. You could have bought here, sold here, bought here, sold here. But when this happened, this guy, that on this day it broke out of this channel. So now Sakatas ACR becomes an invalid setup in this case, right? So so what I am going to do in a couple of in my classes going forward, I will discuss some 10 to 12 setups with you guys, and the idea is to let you guys decide if that makes sense to you or not, and sort of help you develop a trading idea around that setup which you think might work for you. So a very long question to a very short answer. I hope I answered the question.
Yes, I mean, my intention was to know why would one setup, for say, if a setup works for Prakash, why wouldn't the same setup work for me?
Because we think differently about risk, we think differently about trading in general, right? uh, we think differently. If you and me, we are not the same kind of thinkers, we will not be we will not be at the same comfort level with an idea. uh,
Yeah,
yeah, that's the answer.
cool. Thank you.
You're welcome. Raj, you have a question? Raj
So,
Shetty.
Prakash, can you hear me?
Yeah, yeah, audible.
Yeah, hi. So, my question is regarding to the psychology, right? So, you said like once you had a 52 stocks and you have to reshuffle it. So, my question is like how painful it was and how long it took you to reshuffle everything from the laggards to the winners or something, right? So, how was your journey?
Yeah, so my journey was very easy actually. I had to get money for my marriage. so so was an easy decision for me. But I can understand that the process might be very painful to some. But the idea is this, right? Once you come once you make peace or with the idea that, hey, this is actually not a correct thing, then the action, make taking the action would actually be easier. That's the whole point.
Okay.
Yeah, it's very hard for some people to sell. So exactly, so this is the point which I was trying to make earlier to Mr. Verma, saying that, see, selling the pushing the sell button comes very naturally to some, but for some it is the most difficult thing, right? Why is that so? Because we all think differently, and and that's the point which this discussion also brings forward. Now, Raj, I'm pretty sure it's very difficult for you to get rid of some of the stocks which you have accumulated for some time, if I'm right, if I'm not wrong. Yeah.
Yeah, I did. So, I mean, still my portfolio is positive,
Right.
but I still have some laggards.
Right.
Even though they are the good stocks, that's not like a penny stocks or something.
Mhm.
But because due to their results or
Mhm.
some ongoing issues and all, they're down. So I get rid of a lot of things, but still there are a few more left out.
Mhm.
So yeah.
Yeah. So see, one way to think about this is, which I'm going to talk to, which I'm going to discuss in either tomorrow or the next one, is to think about from the lens of a stage analysis. So this is truth that every stock will go in a cycle. So a cycle of accumulation when the big money will buy a lot more, and then there will be an uptrend, and then there will be a phase where it will again go sideways, and then it will drop down. So for example, right now, a couple of the stocks which are doing that is, let's say, let's quickly go to, so yeah, we'll not discuss Adani in the class, okay? So for example, Polycab, right? I'll go to a weekly chart now. So, so Polycab is a great company. I'm sure everyone will agree here. So Polycab started its journey from 600. It has now gone to 3000. So this was the accumulation phase, accumulation stage two, and right now it's most probably at a distribution phase. Okay, I'm not saying that this is gonna go down, but that's my best guess, right? So once you know that this there is a four stage thing, cyclical thing going on, then it will be easier for you to sell. Okay, so that is what I also meant when I said that I expect you to develop a unifying sort of an idea about the markets. So for example, the same thing is happening with something like APL Apollo. A better example देता हूँ, X Pro India. Somehow my internet is not that great today. Just a minute. Anyway, so we will discuss more about it, and probably those things should help you to get rid of the laggards more easily. Uh, any more questions? Yeah, yeah, Raj. Yeah, that was my answer. Yeah.
Sure, got it.
Okay, guys.
Hi, Prakash.
Hi, Ashish. Hello.
So I thought you were going to close, but just a small, maybe expectation, I would say from my side. The thing is, we are working professionals, so I like to have positional trades and all,
Right.
but we can't see the price daytime, right? Maybe once or twice we can see, but we cannot, take trades
Right.
based on that immediately. So I'm into currently mode where I can develop certain strategies where I can take the trades end of the day, well, I mean anticipating them, and if it triggers well and good, maybe for I can hold them for 1 week to 1 month in that time frame.
Right.
I'm okay with that kind of approach. So my expectation is if I can get help in developing such kind of my attitude and my way of trading, that would be great.
Yeah, thanks for the question, Ashish. And I completely understand that approach. And yes, I will definitely be showing setups which are more suitable to that kind of a system. And yeah, I think most of the system would be suitable to that. Okay. So yeah, hopefully you'll get your answer. Yeah,
Okay, yeah, thanks.
yeah, right. Um, okay, any more questions? All right, then. I will stop now. And again, thanks for coming. And I will send you the videos very soon. By at least by tomorrow, I'll figure it out things. And see you tomorrow 10 a.m. And have a good weekend then.
Thank you. Thank you. Bye.
Bye bye.
Thank you. Bye.